Hello, Steve Rondinero reporting. Welcome to New Orleans. It is a great time to be in the car business, but there are always challenges. One of the most worrisome is the federal government's unwarranted and disruptive intrusion into the indirect auto loan market. The Consumer Financial Protection Bureau claims, without providing reliable evidence, the dealers are unintentionally discriminating against minorities by charging them higher amounts of dealer participation, which is a portion of the interest rate that dealers receive for arranging financing. So, it wants lenders to end their current dealer compensation programs and instead pay dealers a flat fee for this service. Now, it's impossible to overstate the adverse consequences of such a policy, hurting consumers and dealers alike, and dramatically altering how credit decisions are made in every dealer's finance office. NADA believes the CFPB charges are unsupported and its remedy is flawed. We'll discuss that during our comprehensive coverage of the issue, but we'll begin with a brief overview. The CFPB wants to eliminate a dealer's ability to meet or beat whatever interest rate the consumer has been offered elsewhere, whether a lender or competing dealer.
Fundamentally, what is at risk is a dealer's ability to price and discount credit in consumer transactions, and that's big.
It's an unprecedented assault on dealer-assisted financing, which benefits customers.
There's a lot of competition in the current system, and that results in broad access to credit at very low prices.
The core issue for the CFPB is the dealer's ability to lower rates.
They don't want a dealer or dealership to have any discretion over the rates.
The CFPB claims discretion leads to unintentional discrimination.
Let's make one thing perfectly clear. There is no place in the car business or any business for discrimination.
The CFPB claims minorities pay higher rates, but it has not cited credible evidence to support that conclusion. It also has not provided critical details about the statistical method it uses to measure for discrimination.
We've asked, members of Congress have asked, and the CFPB has declined to give any details about their methodologies.
The CFPB is pressuring finance sources to compensate dealers with flat fees, which would prevent dealers from offering consumers interest rates that are lower than their competitors' interest rates.
The government wants us to go to flat fees, and it hurts customers because it's going to drive up interest rates for customers, which also drives up their car payments.
There's over 17,000 franchise new car dealers out there, each competing against each other, each with multiple finance sources. Why would the CFPB want to take 17,000 price discounters out of the market and replace that with a flat fee system?
NADA believes the CFPB policies are misguided and will in fact hurt consumers, not help them. We have a series of reports beginning with NADA TV's John Spiropoulos.
Hi Jeff, congratulations.
24,000 consumers on average drive away from car dealerships every day.
Thank you.
In a new vehicle with financing arranged by the dealer.
Thanks.
Often at a better rate
Thank you.
that the consumer could get elsewhere. It happens all across the country. First stop, Bellevue, Nebraska.
They come in, we take their credit information, and then we shop maybe 60 different banks.
Annual interest rate is 2.99.
We can often beat their pre-approved loan. We can often beat it.
Next stop, Hodgkins, Illinois.
We have seen consumers coming into the dealership saying, I've got a relationship with a bank, and my rate at that bank that my bank has offered me is X. Can you beat it? And because of the number of banks that we deal with, generally, we're able to get consumers a better rate than they can at the bank with which they have had a relationship for many years.
Different town, same result, Burlington, North Carolina.
Pretty common occurrence that somebody come in from their credit union or their own bank with a rate in mind or been quoted a rate from that bank. And because we do volume with those banks, we're able to offer them a better rate at the same institution that they're trying to deal with.
It's the same in Montgomery, Alabama.
The great thing about dealer-assisted financing is we'll meet or beat a customer's rate to get their business every day.
But the Consumer Financial Protection Bureau wants to end that. The CFPB claims minorities are paying higher rates. It is urging lending institutions to change the way they compensate and incentivize dealers.
These incentives can result in African American, Asian, and Hispanic borrowers paying more to access credit than similarly situated non-minority borrowers.
The CFPB has provided no credible evidence to support the allegation, and it has hidden its testing methodology from the public. NADA vigorously challenges the basis of its claims, the subject of our next report.
The Consumer Financial Protection Bureau allegation of unintentional discrimination is based on a statistical analysis of past transactions. But did the CFPB get it wrong?
Statistical results are only as valid as the statistical method that is used to produce them.
One major problem is figuring out who's a minority and who isn't. Auto credit applications don't have that data.
So the agency has to use proxies, things like where you live or what your last name is.
Such methods have a margin of error, and this margin of error must be factored into any pricing comparison to make sure the comparison is accurate. That's according to the National Association of Minority Automobile Dealers.
We did really need to look more at the consequences of making sure the data collection is accurate.
It's also vital to make sure that pricing differentials are attributable solely to a consumer's background and not other legitimate factors that can affect how much the dealer earns in a transaction.
You have to make sure that you're comparing similarly situated people.
Is the CFPB comparing similarly situated consumers? It says it is, but it has not identified any factors it's using to make a valid comparison. There are many neutral factors that could explain why customers, regardless of their background, pay different amounts of dealer participation. Some of these factors include the loan amount, loan duration, loan-to-value ratio, whether the vehicle is new or used.
Any one of these factors could greatly alter the finance charges and the interest rate on a consumer contract.
Several other neutral factors that can cause dealer participation to differ. The customer had a strong competitive offer, or a budget constraint requiring a lower monthly payment. The customer qualified for a subvened interest rate, or a dealer's low rate promotion, or an employee discount. Inventory reduction is another factor. The dealer cut the rates to accelerate sales.
None of these have anything to do with a person's background. All of them are neutral, objective factors that explain why one person paid more for financing than somebody else.
But the CFPB won't reveal whether it considered these factors.
And those factors are key to an understanding of whether or not discrimination has occurred.
Which leads NADA to question the validity of the CFPB's allegation. If the Bureau had a reliable testing method, there'd be no need to keep it a secret. Another issue is the CFPB's failure to study how its actions to move the industry to adopt flat fees will affect the cost of credit for consumers. We'll explore that critically important issue in our next report.
Eliminating dealer discretion to lower rates by moving to flat fees as the method of dealer compensation will adversely affect consumers. NADA's leadership explained how in several meetings with CFPB Director Cordray. So has NAMAD, the National Association of Minority Automobile Dealers. Both associations did so again publicly at the CFPB's Auto Finance Forum.
It is our mutual or entire industry's goal for all customers to be treated fairly, which is why eliminating dealer discretion will do more harm than good for the individuals we are talking about.
I think it would be a true disservice to the customer. The customer would end up paying more in an interest rate.
What if you didn't have the meet or beat power that the government may take away from you?
Then that consumer will probably not be able to buy a car.
NADA's Paul Mitri, one of the panel members of the CFPB Forum, warned of the adverse consequences of flat fees.
A broad industry adoption of flat fees would remove the ability of dealers to, as I said earlier, meet or beat the most competitive offer available to the consumer from any other source. This will weaken competition and in turn drive up the cost of credit. This would adversely affect consumers, particularly credit-challenged consumers, who would lose access to conventional financing for their transportation needs.
Not every consumer has spotless credit. And so we find consumers who come into the dealership and they want to buy a car, and they've had some problems in the past. We are able to talk to the banks and leverage our relationship to get these customers done.
Marginal to low credit score consumers may have a difficult time obtaining financing from financial institutions on their own. Banks are not in the business of being an advocate. Dealers are.
There are 17,000 advocates in cities and towns across the country, including Cuyahoga Falls, Ohio.
Nobody's going to fight harder for that customer to get approved for a car loan than the dealer that's selling the car. And we've got people that are trained and experienced in dealing with lenders.
When we tell a bank, Listen, I have interviewed this particular individual. I know what this customer has gone through. This customer is a good customer. Most times, the bank extends credit to consumers who would not have had that opportunity if we didn't go to bat for them.
In the age of using the internet and trying to apply for a loan, in many instances, if you have a blemish on your credit, you're not going to get approved. And that's where the benefit of being a dealer and having that one-on-one interaction, because in the scheme of things, when you look at what a dealer does, a dealer uses his relationships with the bank to make sure that, one, that customer can walk out with the vehicle that they can afford, as well as the price point which that customer wants to pay.
In East Windsor, New Jersey, those relationships mean more access to loans at better rates.
We're very fortunate that we have a lot of very good relationships with financial institutions, the financial arms that we have with manufacturers, some of the community banks in the area because we've been here so long.
The CFPB's threat to upend a system that works while refusing to reveal critical details about its methods prompted NADA to take its concerns to Congress. John Spiropoulos has that part of the story.
Congress specifically exempted dealers from CFPB authority, but lawmakers were unaware of the Bureau's subsequent regulatory overreach.
We went to the Hill and there was a lot of confusion because members of Congress were saying, we thought we had exempted you from the CFPB. So what we explained to them was that the CFPB was going around Congress and regulating auto lenders to try to regulate dealers.
NADA's legislative staff went to many members of Congress with whom they, dealers, and State Dealer Association executives have developed relationships over time. Among them, Democratic Representative Gary Peters of Michigan, seen here with Jackson, Michigan dealer Wes Lutz. It was Peters who cast a crucial no vote during the Dodd-Frank deliberations, exempting dealers from the CFPB.
Mr. Peters.
No.
Mr. Peters votes no.
At NADA's 2013 Washington conference, Peters worried about the effect of government regulations.
I believe that it is absolutely essential that we have a very competitive marketplace so that folks can get the lowest rate that they can for their loans, and certainly your dealer-assisted financing is about that. It's about being competitive in the marketplace. I'm very concerned as well with some CFPB regulations, kind of an end around as we tried to keep you out of the CFPB. They're now doing an end around through the banks to try to perhaps regulate this.
NADA reached out to many other concerned lawmakers. Alabama Democratic Representative Terry Sewell, welcomed by home state dealer Forrest McConnell to an NADA Washington conference. And West Virginia Republican Representative Shelley Moore Capito.
Richard?
With home state dealer Richard Stevens at another Washington conference.
They've been very concerned with what the CFPB has been doing, their lack of transparency, how they haven't talked about the methodology.
The result of NADA's efforts, 9 separate letters from Congress to CFPB Director Cordray.
These were strong letters that asked pointed questions to Director Cordray, but first we had to educate staff, senators, and members of Congress on the benefits of indirect financing.
Among the questions, what methodology is the CFPB using to measure whether disparate impact exists? Has the CFPB studied the impact that flat fees would have on the cost of credit for consumers?
These letters were bipartisan.
One letter came from Representatives Sewell, Peters, and 11 other Democrats on the House Financial Services Committee. Representative Capito and 34 other House Republicans sent another letter to the Bureau. Next, 22 senators, 11 from each party, sent a letter demanding answers. The letters were a prelude to a stern public warning from Congressman Peters to the CFPB in September.
Before you have any kind of regulations, you've got to show us some very strong evidence as to why you're doing this. And if you do not have that evidence that there is a problem, then you should not, and we will stop you from going forward with any kind of regulations that impede your business.
These letters from Congress drew polite responses from the CFPB, but few answers to the hard questions. Meanwhile, frustration in Congress continues to grow. In mid-December, 16 Florida congressmen, 8 Democrats and 8 Republicans, sent a strong letter to the CFPB asking for details on its testing methodology. The members of Congress also wrote that dealer-assisted financing frequently results in a lower cost of credit. We fear the CFPB's guidance will significantly restrict consumer access and choice. NADA's efforts have resulted in an extraordinary bipartisan effort by both the House and Senate to keep auto financing affordable and available. John Spiropoulos, NADA TV.